Have you ever wondered what it takes to be a legendary investor? One who not only foresees the storm but rides the waves while everyone else is seeking shelter? Michael Burry, the genius behind The Big Short, and the man who saw the 2008 housing market disaster, is coming back in the spotlight. And this time, he's delivering a warning that's sending shockwaves through the financial world. Just imagine, he's putting more than $1.6 billion on the line, betting against the giants, the S&P 500 and the Nasdaq 100. In this video, we'll dive into the details, unravel the mystery behind Burry's latest moves, and discover why he's convinced that what's on the horizon is not just another recession, but something way worse. Let's get started. Now, before we dive into Michael Burry's recent predictions and why he's sounding the alarm, let's take a moment to get to know the man behind the forecasts. Michael Burry's journey is nothing short of extraordinary. Born on June 19, 1971 in San Jose, California, he overcame significant hurdles right from the start. One of the most notable challenges was losing an eye to cancer during his early years. Now, here's where it gets even more interesting. Michael didn't just bounce back from eye problem. He studied economics and pre-med at the University of California, Los Angeles, and even earned an MD degree from Vanderbilt University School of Medicine. Yeah, he was on track to be a doctor. But here's the twist. During his residency at Stanford University Medical Center, he realized his heart was really in the world of financial investing. I mean, can you imagine leaving med school to pursue something completely different? That's some serious passion. All right, let's fast forward to the early 2000s when Michael Burry decided to make a bold move by setting up Scion Capital. This wasn't your run-of-the-mill hedge fund. It was like a rebel in the world of finance. Scion Capital, under Burry's leadership, had a fearless approach to the market. They weren't afraid to challenge the status quo and prevailing narratives in the financial industry. You see, what made Michael Burry truly stand out was his unwavering attention to detail. When the housing market was booming, Burry wasn't celebrating. He was analyzing. He took a deep dive into those mortgage-backed securities, which were seen as the golden ticket by many. But here's the kicker here. Burry saw something different. He didn't see gold, he saw cracks in the foundation. While the world was dazzled by the apparent prosperity, he unearthed the hidden risks that others were turning a blind eye to. With his meticulous analysis and relentless research, Burry made a prediction that took real courage. He boldly declared that the housing market was heading for a colossal crash. You've got to understand, back then, pretty much everyone thought the housing market was invincible. It was on fire, and nobody saw the storm clouds gathering. But Burry did. And he had the data, the knowledge, and the guts to go against the grain. He didn't just talk the talk, he walked the walk. He bet against the prevailing narrative and did something audacious. He purchased credit default swaps, essentially using them as insurance against the looming crisis. But here's where things get really interesting. Michael Burry's predictions weren't taken lightly. In fact, he faced something like an investor revolt. Many people questioned the accuracy of his forecasts, and some even wanted to pull their money out of his fund. This was a real test of Burry's courage and conviction. But he stood firm in his belief, and history would eventually prove him right. The outcome was nothing short of astonishing. Michael Burry personally made a profit of $100 million, and his remaining investors enjoyed over $700 million in profit. Scion Capital achieved returns that were off the charts, 489.34% between 2000 and 2008, which was a stark contrast to the modest returns of the S&P 500 during the same period. But let's now talk about Michael Burry's recent prediction. He's taken quite a bearish stance on the S&P 500 and Nasdaq 100. I mean, he's put his money where his mouth is, and we're talking big money, over $1.6 billion to be precise. Now, what's a bearish stance? Well, it means he's betting that the markets are going to take a nosedive, and he's not holding back. How's he doing it? Burry's using a financial strategy known as put options. Think of these as insurance policy against a market crash. When you buy a put option, you're basically securing the right to sell an asset at a predetermined price, even if the market value of that asset plummets. Now, let's unpack why Burry is so bearish. First off, he's seeing a speculative bubble, especially in the tech sector. People are getting all excited about high-growth tech stocks, and that excitement has pushed up their prices, maybe a bit too much. And when things get too frothy, it can be a red flag for a potential market downturn. Burry's also sounding the alarm on inflation. He's concerned that central banks are pumping loads of money into the markets. It's like when you put too much air in a balloon. It's gonna burst eventually. Burry's worried that all this extra money will erode the value of assets and cause some serious disruptions. Another thing that he's pointing out is the rise of passive investing through exchange-traded funds, or ETFs. Now, this might sound like a mouthful, but it's a bit like everyone piling into one side of a boat. It can distort stock prices and create a false sense of stability, which in the long run can be risky. And then there's the not-so-small issue of corporate debt. Over the years, companies have been racking up a ton of debt, and when you have too much debt, it's like walking a tightrope. One misstep, and it's trouble. Now, let's go into some important economic indicators and red flags. One of these is the Shiller price to earnings, P/E ratio, which might sound like a mouthful here, but it's actually pretty straightforward. Think of it as a barometer for the stock market. This ratio takes the average earnings of the market over the past 10 years and adjusts for inflation. When it's high, it's like seeing a price tag that makes you do a double take, and that's a red flag. Why? Because historically, when the Shiller P/E ratio is high, it is often followed by a market correction, or in the worst case scenario, a crash. Another red flag is the influence of political uncertainty on financial markets. Now, politics and economics are like besties, and when things get rocky on the political front, financial markets tend to get jittery. Think about events like Brexit, trade wars, and international tensions. They stir the pot, making investors nervous. And when there's uncertainty about how governments will handle these issues, it can lead to cautious investing and even a loss of trust in policymakers. That's a red flag for market stability because it can affect consumer and investor sentiment, which in turn can undercut economic growth. The growing wealth gap is another big concern. We've all seen the headlines. The wealthiest 1% is amassing wealth at a much faster rate than the rest of us. Now, this isn't just about fairness, it's a concern for market stability too. When the wealth gap widens, it can put a drag on consumer spending and overall economic growth. When a smaller group of people controls most of the wealth, it means a lot of folks don't have as much to spend. And when consumers are cautious, businesses can take a hit, which can lead to market instability. Let's talk about the first lesson that we can learn from Michael Burry, the importance of diversifying your investments. It's like spreading your bets across different horses in a race. You want to spread your investments across various sectors, assets, classes, and even different regions. Why? Well, it's all about reducing risk. You see, if you put all your money into one basket and that basket takes a hit, you're in trouble. But by diversifying, you're not putting all your financial eggs in one basket, and that can help balance things out, even when one sector isn't doing so well. Now here's the rule of the cash reserve, and it's like having an emergency fund as your financial fortress. You want to keep your emergency savings separate from your regular accounts. Why? Because you don't want the temptation to withdraw funds easily to sabotage your financial stability. If you can, stash your emergency funds in a different bank, making it a bit harder to access. Next lesson is all about investing in stable industries for resilience. Think of it as building a house on a solid foundation. Burry suggests identifying sectors like utilities, consumer staples, and healthcare. Why these? Well, they offer essential services and products that people need, no matter what's happening in the economy. So companies in these industries tend to be more resilient during market downturns, making them a reliable choice for your investments. And finally, let's embrace Michael Burry's contrarian approach to investment. It's not about gut feelings or following the crowd. Instead, it's about diving deep into complex financial data, uncovering hidden patterns, and not being afraid to challenge conventional wisdom. Burry's success isn't just luck. It's a result of meticulous research and a willingness to go against the grain. If you've enjoyed this video, guys, make sure to subscribe to the channel, like the video, and watch this one as well. Thanks for watching.